If I had to start investing from zero again as a beginner in Germany with absolutely no financial background, this is exactly how I would do it. Because when I started 6 years ago, I was completely confused. I had never invested in the stock market before. People kept talking about ETFs and I had no idea what they were. And honestly, I was scared. The idea of sending my hard-earned money to some investing app felt very risky. What if I clicked the wrong thing and lost the money in an instant? I wanted to invest, but I couldn't get myself to start. Eventually, I forced myself to begin. I bought a few individual stocks, made some mistakes, learned a lot, then switched to ETFs. By the end of my first year, I was even buying Bitcoin and altcoins, not always at the right time. So in this video, I am going to show you the exact step-by-step roadmap I would follow today if I had to start again from zero as a beginner in Germany. But this time with all the knowledge, mistakes and experience I've collected over the last 6 years. By the way, if you're new here, my name is Ahsan and on this channel we discuss how to build wealth in Germany. We're going to move pretty fast and cover a lot, like why you need to invest in Germany, where to keep your emergency cash versus long-term money, stocks versus ETFs, how much you should invest each month, 3 investment strategies you can pick from, and finally, step by step of how I would set up my first ETF savings plan in Germany. Let's start with the question a lot of people have. Why should I even bother investing? Can't I just save? The short answer is that inflation is slowly eating your savings. And if you plan to retire here, your future pension probably won't be enough. Because when you retire in Germany, you likely face a pension gap between what the state pays and what you actually need to maintain your lifestyle. On top of that, if you just let your money sit in a normal account, inflation makes it worth less every single year. Let me show you how big the difference can be. Imagine you put 100 euros per month aside. Over 10 years, that's 12,000 euros saved. If you don't invest and just park that somewhere with basically 0% real return, that's still 12,000 euros minus inflation. But if you manage an average return of 7% per year, that amount becomes 17,300 euros. Over 30 years, the same 100 euros per month with just saving leads to about 36,000 euros. And invested at 7% leads to around 122,000 euros. Same monthly effort, completely different outcome. That's why saving alone is not enough. You need to invest. But that doesn't mean you throw everything into risky stuff from day one. We need to separate short-term safety from long-term growth. You've probably heard of Tagesgeld or savings account. These are great for emergency funds, short-term goals, and parking money you cannot risk. The problem here is that over the long term, the interest rate is usually below inflation. So your money might just feel safer, but it's slowly losing buying power. Stocks and ETFs are where long-term growth comes from. But yes, prices move up and down, sometimes a lot. So here's the rule I would follow. The money I might need in the next 6 to 12 months, I would keep in my bank account. Money that I do not need in the next 5+ years, I would invest in the stock market. So before we dive in deeper, let me quickly explain stocks and ETFs in simple English. A stock is a small piece of a company. If the company grows and profits, your shares become more valuable. If it fails and goes bankrupt, your shares can drop to zero. For example, Apple. You can buy an iPhone or you can buy Apple shares and be a small owner of that company. ETFs or exchange traded funds are like baskets of many stocks. Instead of buying one apple, you buy a fruit basket. Apples, bananas, oranges, etc. If one fruit rots, you still have the rest. Some ETFs hold hundreds or even thousands of companies worldwide. That means lower risk than single stock, very good for beginners, and no need to constantly research individual companies. We'll talk in a second about how to pick a good ETF. Now here's where 99% of expats in Germany get stuck. They start researching which broker, is Scalable Capital better than Trade Republic, which ETF is the best. What about taxes? What if I move back to my home country? Suddenly you have 20 tabs open and 0 euros invested. I went through the same thing. I wasted time and overthought every decision. What I wish someone had told me back then was to start small and learn by doing. So here's how I would do it if I had to start from zero. Before investing, we need to protect ourselves by building an emergency fund. As a student, aim for around 1,000 euros. As a single full-time employee, 3 to 4,000 euros, and with a family and kids, 8 to 9,000 euros plus. Put this in a separate bank account, ideally a free one, and don't touch it unless it's a real emergency, like job loss, urgent medical bill, or big unexpected repair. This is the money that stops you from panic selling investments later on. Next, we need to know how much you can invest per month. For that, open your banking app and review your last 90 days. One column has money going in and the other column money going out. And find your average monthly saving. Now set a target savings rate. Absolute minimum, in my opinion, is about 10% of your net income. Better would be about 15% or more. And 30 to 40% would be totally amazing, but that depends on your income and lifestyle. From that savings amount, decide how much goes into investing. If I'm saving around 15%, I would invest maybe 10% of my income. If I'm saving 30 to 40%, I'd invest 30 to 35% of my income. You can adjust the percentage later. The important part is to start with something realistic and automatic. Next, we have your investment time horizon, which means how long you plan to keep your money invested. Short horizon of 2 to 3 years means you cannot afford big market drops. Long horizon of 10 plus years means you can ride out crashes. Think of 2000 or 2008. Those were huge crashes. But over 10 to 20 years, markets historically recovered and reached new highs. If I were starting today, I would choose at least a 10-year horizon for my ETF investments, and if I know I'll need money in 5 to 7 years for a house down payment or a big move, I can still keep that money in the stock market. Now we're ready to talk about what to buy. If you want to keep it as simple as possible, I would go for a globally diversified ETF that tracks a world index. Two popular global indices, the MSCI All Countries World Index and FTSE All World. Both include developed countries like US, Germany, France, etc. and emerging markets like China, India, Brazil, etc. So here is how I would choose a good ETF. First, pick an index, for example, FTSE All World, S&P 500, etc. Then look up ETFs tracking it. Then filter for fund size with at least 100 million euros plus, type like accumulating or distributing, and ongoing charges, total expense ratio, where the lower the better. You might end up with options like Invesco FTSE All World ETF, Vanguard FTSE All World ETF, or the iShares Core S&P 500. For a beginner, you basically cannot go terribly wrong with a broad world ETF like that. If you're looking for Sharia-compliant ETFs, then these three options are a good starting point. Write down or save the ISIN or WKN of the ETF you choose. We'll need that in a moment. To actually buy ETFs, you need a depot or an investment account. In Germany, you have traditional banks, which are often more expensive, and online brokers like Scalable Capital, Trade Republic, etc. I personally use Scalable Capital and have been using it for over 5 years now. So I'll use it as an example. Here's roughly what happens when you open an investment account. You fill out an online form with your personal data, tax residency, etc. You answer some questions about your experience with investments. Then you verify your identity via video ident with your ID or passport. The broker opens your investment account and you'll get access via the app and web. While the investment account is being opened or right after, I would set up a standing order from my normal bank account to my investment account. For example, every month on salary day, send 100, 200 or 300 euros to your investment account. This way, you pay yourself first. Investing happens before the money gets lost in random expenses. And mentally, you know this money is already gone to future me. Now the fun part, actually investing. Inside Scalable Capital, this is roughly how I would do it. Open the app and go to the search bar. Paste or type the ISIN or WKN of your favorite ETF. Or you can search for the ETF directly. Tap on the ETF, select Savings Plan. Now choose your monthly amount, the frequency, the execution date. I like shortly after my salary day. And decide if the money is taken from your scalable cash balance, which I send myself from my bank account, or directly via direct debit from your bank account, where I don't have to manually transfer from my bank account to my investment account. Then tap Activate Savings Plan. That's it. You've just created your first automated ETF investment in Germany. You can see all your active plans in the app and pause them, change the amount, or delete them at any time. Please hit the like button if you're getting value from this video and consider subscribing. Now that your savings plan is running, here's the most important part. Leave it alone and stay consistent. The stock market will move up and down. Some months your ETF will be in the green, other months it will be in red. This is where risk tolerance becomes real. When I started investing, about 20 days in, my portfolio dropped 6% in a single day. 4% was just because the market, and the other 2%, that was me panicking and selling. Then the market recovered and went higher, and I bought back in at a worse price. I literally paid extra for my own fear. Since then, I decided that my personal emotional limit is about a 20% drop. As long as I'm investing for 10 plus years and I am diversified, I accept the ups and downs. You need to find your own number, but be honest with yourself. It's better to invest a bit more conservatively and stay in the market than to go aggressive and panic sell. Now that the basics are clear, here are 3 strategies I recommend depending on your risk tolerance and interest. Strategy 1. All ETF portfolio. 100% in a single global ETF like the FTSE All World or MSCI, which is truly a set and forget it portfolio. It's perfect for you if you don't want to think about individual stocks, want global diversification, and have a long-term time horizon. You can run this one savings plan and honestly never look at individual companies. Strategy 2. ETF plus individual stocks. Here you combine the core 70 to 90% in global ETFs and satellite 10 to 30% in individual stocks you believe in, which you think have higher risk but higher potential return. This is where stories like Wirecard, FTX, Silicon Valley Bank, and many others come in. Some companies go to zero. I've personally had stocks that went bankrupt, resulting in total loss. On the flip side, I've also had winners. For example, my position in IBM has given me over 78% unrealized profits so far. So you just need to accept that individual stocks require more research, more emotional control, and you must be okay with the ability of a total loss in that part of your portfolio. Strategy 3. ETFs, stocks, and crypto. This is what I currently do. I keep most of my portfolio in ETFs and solid stocks. A small slice of between 5 to 10% goes to crypto. But honestly speaking, crypto is extremely volatile and a 50% drawdown is not unusual. I include it because the potential upside, but limit it because I know it can crash hard. That way, if crypto goes to the moon, that's great. But if it crashes, my life doesn't. Now, a quick note on something that scares a lot of expats is taxes. The good news is that if you use a German broker like Scalable Capital, they automatically handle the standard capital gains tax for you. So you don't have to manually calculate and send the money to the finance arm with every trade. There are ways to optimize taxes further, but as a beginner, don't let this stop you. You can learn the details later. If you want an even detailed video on how to start investing in Germany and where I invest my own money, then you can watch this video. And in this video, I share is saving 100,000 euros in Germany even possible or not.